I'm Foreman, and this week I'm going to show you the UK stocks I bought, the top riser and faller in the portfolio, as well as a new position that I opened this week. And if you find the video useful or entertaining, please drop one of these to support the channel. According to Google Finance, the FTSE 100 is down by 2.09%. Similarly, the FTSE 250 is also down 2.09%, and the S&P 500 is down by 0.92%. There's a lot of 2s and 9s this week for some reason. Maybe there's a sign. My portfolio, however, does not follow this trend, and for the second week has consistently underperformed the markets by quite a severe margin. My portfolio is down by 6.13%, which is quite impressive. Not only did I just manage to underperform, but I managed to triply underperform the rate of the large cap stocks in the UK. This is due to a number of compounding reasons, but mainly due to my high exposure to my equity positions, in which I have a majority of my investments with my top 2 positions. And of course, these are the ones that have dropped the most this week. But I'm not concerned in any way. Sure, I've dropped by 6.13%. Sure, I'm now underperforming the FTSE 250, but this is still the short term. And ultimately, I'm not going to adapt or pivot my strategy to chase high returns by following clean energy or electric vehicle hype, but rather I'm going to continue doing what I believe I do best and continue researching the markets, and hopefully, even if I don't outperform the markets in this time period, that I learn enough so that in future I may be able to outperform the markets. And sure, this is the second consecutive week that I have underperformed, and that, yeah, you could argue I could go and buy a FTSE 250 index fund and have better performance for a lot less effort. But this, as I said, is still the short term. I can't base my performance over some weekly changes, but rather I need to track this over the longer term, a longer time horizon of at least 5 years, to really see how well I've done over that time period. So I'm not going to quit at any point now. I'm going to continue buying and holding stocks that I think are of a good quality and will do well in the future, and my strategy isn't going to change too much, but then I don't know what I'll do in the future. Perhaps I'll go a little bit bizarre and chase high growth stock, penny options, or 3 times long on a stock destined to fail. Who knows? I'm hoping that over this time period I'm rewarded with higher returns by researching the markets, specifically the AIM and main markets, more in depth. And hopefully that will obviously push up my performance. There is a statistic that, obviously this is going to be off the top of my head, and so it's likely inaccurate. Like they say, 90% of all statistics are false. This one isn't a numerical based figure, but what it had said is that a majority, or in most situations, active fund managers outperform in a market that is under-researched. And I believe this is strongly the case for the AIM markets. And so I'm going to put a lot more of my attention into there. I still think there's some high quality options. It also falls in line with what I discussed last week about London Stock Exchange Group being a £30 billion company, and that despite their high quality, I still believe that their best of their growth is behind them. And so I don't think it's unwise to also research the AIM markets. The top topics of the week start with Associated British Foods, or their subsidiary Primark. 305 of 389 of Primark's global stores are currently shut, with all of them in the UK obviously being shut due to the lockdown. So naturally, customers are a bit agitated and annoyed that they can't go in store and buy their cheap clothing products, which poses some controversy because these customers want to buy these products, and so they would actively be buying them online if there was a service available. Yet despite the warning that the lockdown could cost Primark over £1 billion in lost sales, they still are not interested in building an online platform. And this is due to it impacting their margins, and this would mean that they would have to increase the price of their goods, which would then in turn lead to less customer satisfaction and likely a loss of market share. And it seems very unlikely that Primark are going to be an online e-commerce company in anywhere in the near-term future, and I personally think it could be advantageous to be one of the last high street retailers, as at that point there would be less competition, and likely it would be more favourable to a fast fashion cheap goods outlet like Primark. especially if we are entering the deepest recession of our lifetimes. But obviously, on the other hand, this means the likes of Boohoo and ASOS can continue their online dominance and growth, which really pushes Primark behind in scale. Which quite smoothly brings me on to Boohoo's trading updates and subsequently why they are the top faller in my portfolio this week, dropping by 8.59%. On January 14th, they had announced their half-year results. No, that's a lie, their trading update, my bad. And they'd announced that they had strong peak trading performance, as well as 40% revenue growth in the last 4 months. Furthermore, their net cash had increased to £386.9 million from £344.9 million last year, which could certainly place them in a much better position to acquire some of Arcadia's brands should they desire them. Although they'd also upgraded their future guidance. Initially, they had predicted that for the full year, they would have a revenue growth of around 28 to 32%. Now they're more confident, a majority of the year has passed, and they're forecasting a growth of 36 to 38%. Which I think is still quite conservative when we can see that visibly they've had 40% and above revenue growth in the last 10 months, which still anticipates a decline in the next 2 months, which has likely knocked investor sentiment back a bit. But then again, you don't really think January and February are big trading months. Even my ad revenue on the channel has fallen through a roof. These results are great, right? Sure, the rest of Europe hasn't performed as well as it had earlier in the year, and obviously the US revenue growth has been declining. But this should therefore push the share price up, right? Well, I personally believe this is a strong overreaction from the markets. It seemed like every Boohoo investor was anticipating this drop after the trading update. Since it had happened in the last 2 times in the last year, it was going to happen again, surely. So this had meant traders had been taking profits, likely prior to the announcement and after. Then this had led to an overreaction, causing a minor sell-off, which had hit stop losses or activated them, so more holders had then sold out, and that had led to that around 8% drop in the last week. Furthermore, there is more competition on the possible acquisition of Topshop, with JD Sports now joining the bidding war, which obviously isn't great if Boohoo was after the fall of Arcadia and after some of their brands. But then again, Boohoo doesn't really need these brands. They have a multitude of their own brands already, and so Topshop, whilst the brand loyalty and recognition can be big for the business, isn't exactly needed and shouldn't really justify such a sharp share price fall, especially when you consider the fall of Arcadia means there's less active competition. They also look to update their supplier list every 6 months, with the UK Tier 1 and Tier 2 suppliers coming out in March, which I think is promising going forward, and this could lead to a lot more ESG funds potentially buying back into Boohoo stock. And especially with their auditor being replaced, initially there were concerns that there were possible fraud and that was why the auditor was resigning, but then since this auditor has replaced them, they were required to announce this, and we'll have to thank a regular viewer concerned voter, as I would not have known this specialist knowledge. But this basically de-risks the investment on bad accounting or bad standards of trade being fraud, for example. Therefore, I seem it very unreasonable that the share price has dropped like this, and I think this is probably more of a good thing than it is a bad thing. This is likely sentiment dropping down slightly so that then we could have a stronger growth in the future. And this could be a buying opportunity in which people could buy shares and ride up this strong year, which I anticipate for Boohoo. I can't see much more media articles coming out, but then again, how could I foresee this as I'm not an insider of the business? But I feel like the articles that could come out, could they really get worse than the slavery scandals that they already were? These could be my famous last words, but I feel that investors are more resilient to the media articles now, and I think the company is transitioning from a more typical mediocre company with strong financial growth to a fantastic company with that strong financial growth. There's absolutely no reason for me to sell my position with Boohoo, as my personal sentiment with the company has increased. I've been through multiple trading updates which have been fantastic, and therefore I'm more confident in the business than ever. They've got less governance risks, and yet the share price is still trading at only 4% up in the last year. I still hold 2,500 shares of Boohoo stock, and if it drops much further, I will be likely topping up this position. And if you'd like a free share, you can sign up to Trading 212 using my link in the description down below and just deposit £1 for that free share. This can also apply to Freetrade, which will also give you a free share. So if you'd like 2 free shares, click those links in the description down below. This week, the London Stock Exchange Group has passed the last major hurdle in the acquisition of Refinitiv, a global data provider, and this will create them into a global data provider and market infrastructure company. This was being investigated by the EU regulators over unfair competition concerns from their competitors, but they've been given the all clear for the $27 billion acquisition of Refinitiv, and now most of the hurdles are out of the way. Singapore are still deciding on this, and their regulators are obviously, they haven't made a decision, and these are some minor hurdles that could certainly stop it. But with the US confirming it in the last year, the EU confirming it, it seems very likely that this acquisition will take place in this quarter. Ultimately, I'm not going to be buying more shares of LSE. I'm not concerned about the acquisition, I think it will go through, but last week I had discussed about market capitalizations and where that growth potential would be, and so I'm going to use LSE as a store of value. They may be volatile in the coming months, but I'll likely sell this when I see a higher stock opportunity with more value. I don't think it's a bad stock by any means, I think it's a fantastic company, but it has less growth potential, which I deem lower risk for my age and tolerance. But if you're someone in retirement, for example, and you would like perhaps a lower dividend yield but much more consistent growth, or perhaps you've got 10 years to retirement, then LSE could probably be a great option. The top riser in the portfolio didn't actually rise but had actually declined by 0.57%. This stock is Ashtead Group, which I seem to routinely mention on the channel, yet still not get the hint. They've consistently outperformed, they are the top performer in the portfolio, and I've not bought shares since September. And in hindsight, it would be fairly obvious to say, yeah, I would have loved to have bought more shares of this stock. I don't know why I just put my thumbs up. I'm kind of overreacting with gestures here at the moment. But it is certainly a valuable learning lesson. I've learned that I shouldn't rely on these high quality growth and momentum stocks, but also I should dedicate some value or time into the value stocks themselves. I think a balance between them can give you a lot more diversification and you can benefit from the different trends in the market. At the moment, it very much seems like value stocks are outperforming growth, whereas earlier last year, growth stocks were certainly outperforming value. I think these trends are constantly going to cycle between each other, so why not get the best of both worlds and invest in both value and growth? So when I open new positions, I'm likely going to be more considerate of this, and where available, try to invest in more value opportunities. This week I bought more shares of Games Workshop, and I believe they have been oversold, much like Boohoo, as they've dropped by a staggering 8.3%. And this was as they posted their half-year results, which I believed were actually really good and promising. We've seen incredible revenue growth from £148.4 million to £186.8 million, with earnings per share increasing from 145.9 pence to 226.1 pence. Despite a decline in royalties, which is by far their smallest revenue stream, they've still seen organic growth in their trade and online segments. Sure, their retail stores have been struggling, but we've been in a lockdown for a majority of the last year, or at least in my opinion, perhaps I've just not left the house enough, and that's probably why I feel like that, but it certainly feels like it's been the case. I believe they have tons of valuable IP or intellectual property that they have yet still to monetize, and therefore I think the royalties can certainly grow. They can diversify into more of an entertainment business in which they are providing animated TV series and perhaps films in the future. And I think another short-term weakness with an incredible stock is another buying opportunity for me. And so I bought 2 more shares of Games Workshop this week, and this is quite a lot considering I'm still rebuilding my emergency fund, and that is my utmost top priority at the moment. My total holding is 52 shares of Games Workshop now, and I'd like to continue building this position up so long as they show weaknesses in share price. And in fact, I'd like to do a Games Workshop stock analysis this week, and if you'd like to see that, please leave a comment down below, as I've not really covered any of the stocks I hold, and I think a few people have requested for that. Instead of the usual share tip of the week, in which I would find a stock that I think shows some value and therefore recommend it to you, I've opened a new position with a new company, and I think that should ultimately replace this segment for this week. Whilst by no means is it in any way a significant position size, and at the moment the size of the position is quite a joke compared to my overall relative portfolio, but I hope to slowly build equity in this position utilising dollar cost averaging or pound cost averaging, in which I'm buying them at their highs and lows over that time period of building equity in the position. I hope to build it up to a similar size of Games Workshop and have it as one of the core holdings in my portfolio, as they have a lot of growth potential in front of them. This is a company that I've been following for quite a while, and in fact, over the time that I've been following, their shares have actually doubled, which by definitely means I've not gotten a high value on this stock, and at the moment they could be at a very overvalued valuation, but as I said, I'm happy to just put small consistent sums of money into this stock, and it's a lower share price per share. Rather, you've got Games Workshop that's around £107 per share. This stock is less than £10, so I can throw the excess change into this stock and buy a consistent amount of shares each week. But I believe over the longer term, these shares will show more value, as in 5 years' time, they could certainly be worth a lot more. They are a video games developer and label for independent developers worldwide. They are listed in the AIM markets with a market capitalisation of £1 billion. This stock is Team 17. They've had truly brilliant revenue growth and scaling profit margins, as well as an absolutely fantastic balance sheet with rising equity, cash and absolutely no debt. I believe they have long-term growth potential as their brands or franchises like Worms and The Escapists are growing in popularity. I don't want to dive too deep into the sector in this video, otherwise it would be too long, but in my personal opinion, I feel that there's a large-scale transition, and this is from the typical AAA games. I think they're actually of a lower quality at the moment. These developers are getting too complacent. They're pushing out really poor quality gameplay. I don't really want to talk about Cyberpunk, but that was a very buggy mess for a lot of people, and they've had to apologise multiple times. But you've got the likes of your sports games that aren't really upgrading at all each year, and are the same thing, just rebranded. Furthermore, you've got the likes of Call of Duty, which really isn't innovating in any way, and so I feel that consumers are aware of this. They've realised the messy production that they are and how buggy they are, and that they're over-riddled with microtransactions, that they prefer to buy more indie games, in which Team 17 is well placed for this peak or growth of demand, as they work for these independent developers, can provide them under their label, but they also provide their own indie games like the Worms franchised or Overcooked, which I believe Team 17 can continue to build a dedicated player base and fan base, as their products have a wide age range and multicultural acceptance. In this way, I would compare them to Nintendo, with the sole idea being that you could probably see some of their products in a family household and well known across the gaming industry. Obviously, Worms is a bit graphic and probably a little bit too much for a 3-year-old, for example, but like you could certainly see your family playing this if you're over the age of 11, for example. And they still have such a long way to go. I will admit I was tempted to purchase Frontier Developments, although their most recent trading update had really sketched me out, as they were very elusive about their performance in the last year. They said that the first half was great, kind of ignored the second half, and said that it remained in line with expectations while saying that we had done well. It kind of gives me the hint that they hadn't done well in the second half, and their revenue and earnings had been very cyclical. And even though I like Elite Dangerous, one of their products that they hold, I'm not going to buy them over pure bias. So I'm investing in Team 17. I bought 5 shares at an average cost of around £8.58 per share, which in no way represents high value, but I hope to build this up over the longer term, as I had mentioned. Furthermore, they're likely to provide a trading update in the next few weeks, which would likely mean that we could see a valuation re-rate, which could mean they go down like a majority of my holdings have in the last week, or they might go up. If they go down, there's a buying opportunity, and I'll pour more equity into the position. I'd also like to mention that I've created a pie on Trading 212, and this means you can view my ideal holdings and allocations, as well as my investing strategy. I'm going to put the link for this pie in the description down below, and you're able to copy it for yourselves if you'd like to, but I highly encourage you do your own research prior to this, as you may lack the conviction of knowing when to buy or sell the dips. But I'd like to say it is on Trading 212 now, and you can view that pie and my ideal allocations, but obviously at the moment I'm overweighted to Boohoo by considerable amounts. My other positions are significantly underweight. If you're interested in how to invest tax-free in the UK, then click the card at the top right of the video. Thank you for watching. Have a great day.